Gold's share of global international reserves just jumped to 18% in 2023. That's the most in 27 years, and it's now also the second largest asset held in global central bank reserves, exceeding the euro for the first time ever. The US dollar is at 48%, but down from 60% in 2017. And at the same time, the central banks in Q1 2024 bought more gold than ever before. So when you talk about this stuff, they're selling treasuries, they're buying gold, and they're being incentivized to do so. And it's one of these deals where now the official world gold reserves are higher than just before Nixon closed the gold window. I mean, it's almost as if they are thinking we are heading towards a gold standard, which would make sense. And to give you an idea of how fast things can change, right? The Bank of Japan, and this is the last thing I have to talk about, I think. There might be a few other things to talk. A couple things. I got a few more to talk about. So the Bank of Japan spent between April 29th and May 1st, in just a few days, the Bank of Japan spent $68 billion to give the illusion that the yen was not collapsing. And this is one of the reasons they keep the price of gold down, because they don't want, them to rush to the fact that the yen or any of these Western G7 currencies are in trouble. But in the last 6 months, an ounce of gold in Japan, because of all this money printing, has gone from 290,000 yen in December of 2023 to 361,000 yen in June of 2024. 71,000 yen more to buy 1 ounce of gold. And this is what happens when you start printing money to buy the debt. That's monetization. And on a price increase, you're talking 30% gain in a very short period of time. This is how fast things can move in a depreciating currency environment. Let's see, anything else? One of the things that I find completely stupid is that the Western media is claiming that the PBOC has stopped buying gold, and this is why gold has fallen. It's just ridiculous. First of all these forever people have been saying you can't believe the numbers that China puts out. The analyst from the Bank of Montreal just said that a few weeks ago. Can't believe the numbers. They're way understated. The IMF has said they're way understated. Alistair McLeod, one of the smartest men in the world, says they have 38,000 metric tons, yet they tell us they only have about 2,500 metric tons. Who's telling the truth? Who isn't? So when you talk about premature conclusions, how can anyone say just because of one report saying unchanged monthly holdings that China is not buying gold anymore because it's too expensive? It's total bullshit. And I would say that they're not going to tell us how much they're buying. And even if the numbers that we have been seeing for 19 straight months, if they have been buying, they've probably been buying a whole hell of a lot more than they tell us through sovereign wealth funds and less transparent, much more opaque ways of bringing gold into the country. At the same time, they're the largest producers in the world, and they've been producing gold at uneconomic levels using our trade imbalance forever. So for people to say 1 month's unchanged numbers, they're done buying gold, this is why the price fell, is as stupid as anything I've ever seen in the Western media and their stupid rhetoric trying to throw people off the scent. Look, you have 4 or 5 companies that control all the media. It's a bunch of bullshit.
Schectman continues his discussion by addressing the broader implications of these financial shifts, particularly focusing on the potential for a return to a gold standard and the strategic maneuvers of countries like China and Japan. He emphasizes the importance of understanding these trends and positioning oneself accordingly to protect and grow wealth. The idea that we might be heading towards a gold standard is not far-fetched. Historically, gold has been the bedrock of economic stability. Before 1971, the global monetary system was anchored to gold, ensuring that currencies maintained their value. The current behavior of central banks, repatriating gold and increasing their reserves, suggests a recognition of gold's enduring value and a possible preparation for a more gold-centric monetary system. To illustrate how quickly things can change, Schectman points to the Bank of Japan's recent efforts to stabilize the yen. In just a few days, the bank spent $68 billion to give the illusion that the yen was not collapsing. This kind of intervention is unsustainable in the long term and highlights the fragility of fiat currencies. The rapid appreciation of gold in yen terms, from 290,000 yen per ounce in December 2023 to 361,000 yen in June 2024, demonstrates the speed at which currency devaluation can occur and the protective value of gold in such an environment. Schectman also tackles the misinformation spread by Western media regarding China's gold purchases. Contrary to reports that the PBOC has stopped buying gold, evidence suggests otherwise. Analysts have long doubted the accuracy of China's reported gold reserves, with estimates suggesting the country holds significantly more gold than officially disclosed. This strategic opacity allows China to build its reserves without attracting undue attention, positioning itself advantageously in the event of a global financial reset. It's essential to recognize the broader strategy behind these moves. Countries like China and Russia are not just accumulating gold, they are also reducing their dependence on the US dollar. By selling treasuries and buying gold, they are hedging against potential geopolitical risks and economic instability. This strategy reflects a broader trend of moving away from fiat currencies, which are subject to manipulation and devaluation, towards tangible assets that offer stability and security. The increasing trend of central banks repatriating their gold further underscores this strategy. When central banks bring their gold reserves back home, they are ensuring that these assets are under their direct control and not subject to foreign policy or economic sanctions. This move is a clear signal of distrust in the current global financial system and a recognition of the need for self-reliance in uncertain times. For individual investors, these trends offer valuable lessons. Diversifying a portfolio to include gold and silver is a prudent step in protecting against economic volatility. Unlike fiat currencies, which can lose value rapidly, precious metals maintain their worth and provide a hedge against inflation and currency devaluation. Gold and silver are universally recognized and easily liquidated, making them ideal assets for financial security. The potential for sudden changes in the financial landscape means that investors need to be proactive. Holding tangible assets like gold and silver is not just about protecting wealth, it's also about ensuring liquidity and stability in times of crisis. As central banks continue to adjust their strategies in response to global economic shifts, individual investors should consider doing the same. Schectman's insights highlight the importance of understanding these broader economic trends and positioning oneself accordingly. The strategic moves by central banks to increase their gold reserves and reduce their reliance on the dollar are clear indicators of the changing dynamics in global finance. By paying attention to these trends and adjusting investment strategies accordingly, individuals can protect their wealth and ensure financial resilience in an unpredictable world.
It's, to me, interesting when you realize, A, that leading up to that, the commercial banks had massive short positions on silver, some of the biggest I've ever seen. B, that, they show up at the Shanghai Exchange where the only thing you can export is silver. And C, right at the same time, we see all of this drawdown off of the Shanghai Exchange. You have 4 weeks in a row, these big short bullion banks show up there. What was discussed, who knows? But, I will tell you that it was pretty obvious that we were going to see some sort of a pullback, I guess. Either that or the commercial banks would have been run over because their short positions kept growing and growing and growing leading into this last pullback. Now, what that means to me is that they had enough silver to deliver those people who were standing for delivery, but it's as if obviously when they were record short and then there's a drawdown, what is happening is that the commercial banks are taking the other side of the trades that the bullion banks, or that the hedge funds rather, are putting on, which would mean the hedge funds are going short and selling longs to the commercial banks who are covering shorts and taking those long trades the other side. That's why one of these days the commercial banks will have hoodwinked the managed money into going short. They have taken the other side and go long, and they let it run, because to continue to try and naked short this market is insanity. There is not enough physical silver to deliver. And what differentiates this market over markets in the past is the amount of deliveries, where these markets never really were designed to deliver product, that they have to allow it to maintain the illusion of legitimacy. But these countries that are standing for delivery, like India, who bought more silver in the first 4 months of the year than they did of all of last year. Well, they're standing for delivery. India bought more gold, 1.5 times the amount of gold that they bought all of last year in the first 4 months, and then repatriated 100 metric tons from the Bank of England. The concept of counterparty risk is becoming pervasive, and I think these countries who were never sophisticated, wealthy, or coordinated enough to drain the exchanges now are, and they realize that's how they win this battle against the West, is not to fight them with sticks and stones, but to damage really the bullion banks, which are the commercial banks, the ones that have these too big to fail massive balance sheets, by standing for delivery in a massively overly rehypothecated environment where in the game, when the game was originally started, and most of my career, 1% or less of these contracts stood for delivery, and now you're seeing large delivery requests bleeding down the exchanges. And I pay close attention to the Shanghai Exchange, because if it keeps bleeding down, where are they going to get the supply to stand for delivery next time? Because we're already at the second lowest level of silver in the 140-year history of the LBMA, and there's only roughly 60 million ounces registered on COMEX. There's not enough silver to go around, and by the admission of the LBMA that they're trading upwards ends of 2.9 billion ounces of silver per day, which is 3.5 times global mine supply per day, it's a silly game in an environment where countries are requesting deliveries. So yeah, this is more and more compelling argument that we're getting close to seeing the end of the ability of these banks to naked short. You can only suppress a market or manipulate one over an extended period of time by pushing in the direction that it is going. And when you have all of these countries intent on accumulating commodities, a la Zoltan Pozar, and Bretton Woods 3, a system about he who has the commodities makes the rules. I think that is also true with silver. And when you look at silver being the most largest concentrated short position by a handful of banks of any commodity traded, it just coils the spring that much more and gives the potential that this could blow up in a very bad way and bring down some of these very large, too big to fail banks. And what does that do to the whole system? That's why when guys like Bix Weirs used to say that silver is the Achilles heel of the whole system, I never quite understood it.
As we delve deeper into Andy Schectman's analysis, it becomes evident that the ongoing shifts in global finance, particularly the strategic movements away from the US dollar and towards gold, are not merely temporary adjustments, but signify a fundamental transformation of the global financial landscape. One of the most compelling points Schectman makes is about the potential return to a gold standard or a gold-centric monetary system. This idea is supported by the substantial increase in gold reserves held by central banks worldwide. The fact that gold's share of global international reserves has surged to 18%, surpassing the euro, indicates a significant pivot towards tangible assets. This trend is further amplified by the decline in the US dollar's share of global reserves, which has fallen from 60% in 2017 to 48%. The strategic importance of these moves cannot be overstated. By selling US treasuries and buying gold, central banks are hedging against economic instability and geopolitical risks. This behavior suggests a lack of confidence in fiat currencies and a recognition of gold's enduring value. The rapid appreciation of gold in various currencies, such as the yen, underscores the protective value of gold in times of monetary expansion and currency devaluation. Schectman also highlights the role of media narratives in shaping public perception. The Western media's claim that the PBOC has stopped buying gold is a prime example of misinformation. Analysts from various institutions, including the IMF and the Bank of Montreal, have long argued that China's reported gold reserves are significantly understated. Alastair MacLeod estimates that China holds around 38,000 metric tons of gold, far more than the official figures suggest. This discrepancy highlights the opaque nature of gold purchases by countries like China and the strategic importance they place on accumulating gold. This strategic accumulation is not limited to gold. Silver, too, plays a crucial role in the global financial system. Schectman notes that the commercial bank's massive short positions in silver indicate an attempt to suppress its price. However, the increasing demand for physical delivery, particularly from countries like India, suggests that this strategy may not be sustainable. India, for instance, bought more silver in the first 4 months of the year than in all of the previous year and repatriated significant amounts of gold from the Bank of England. The implications of these trends are profound. The growing demand for physical delivery of precious metals is straining the supply, highlighting the risks of over-leveraged financial instruments. In an environment where large delivery requests are becoming more common, the ability of banks to meet these demands is increasingly in question. This situation underscores the importance of holding tangible assets that are not subject to the same risks as fiat currencies or financial derivatives. For individual investors, these trends offer valuable lessons. Diversifying a portfolio to include gold and silver is a prudent step in protecting against economic volatility. These metals provide a hedge against inflation, currency devaluation, and geopolitical risks. Unlike fiat currencies, which can be manipulated and devalued, gold and silver maintain their value over time. Schectman's insights emphasize the need for investors to be proactive and informed. The ongoing shifts in global finance, driven by strategic moves by central banks and geopolitical changes, highlight the importance of holding tangible assets. By understanding these trends and positioning themselves accordingly, investors can protect their wealth and ensure financial resilience in an unpredictable world. In conclusion, Andy Schectman provides a thorough analysis of the shifting dynamics in global finance. The increasing importance of gold and silver, the strategic moves by central banks to reduce reliance on the US dollar, and the rapid changes in currency values underscore the need for a stable store of value. Gold and silver offer a reliable hedge against economic uncertainty, providing stability in an increasingly volatile financial landscape. As central banks continue to adjust their strategies, individual investors should consider the role of precious metals in their financial planning. By diversifying portfolios and holding assets with intrinsic value, investors can safeguard their wealth and navigate the complexities of the global financial system. So, in light of everything discussed, it's clear that understanding these shifts and preparing accordingly is crucial. If you want to stay ahead and protect your financial future, consider incorporating tangible assets like gold and silver into your investment strategy. Stay informed, stay proactive, and remember, in the world of finance, being prepared is half the battle. If you want to stay most up to date on the silver and gold markets, make sure to subscribe to my daily 5-minute silver and gold newsletter. It provides the latest expert insights, breaking news, market trends, and investment strategies, all in a concise format. Click the first link in the description to join thousands of others and enhance your investment knowledge right now. If you enjoyed this video, please give it a thumbs up and subscribe to my channel. Your support helps me stay motivated to bring more valuable content to you. See you in the next video.